our first, let's call it investment call, where our investment team sits together and thrashes through a few topics that are current in our environment. And I guess the loose topic today that we want to touch on is really how does diversification actually work in this current environment? Is it still there? Is it still useful? What does it look like? And just get some pragmatic and practical examples and then just chat through that. And I think what we're talking about in terms of what Bram was saying in respect to a lot of market commentators. So what we try to predict is to say, okay, in our local context, when will this pandemic kind of peak? And I think the thing with asset allocation, I'm wondering to what extent is news flow useful in terms of making your asset allocation decision? So would correctly identifying a peak in the pandemic change your asset allocation? And what would that look like? So these are the things that point towards still a huge amount of uncertainty, what the world will look like and what is applicable, and is it going to change? I don't know.
Johan, for me, the debate is, and we had it in earlier this morning investment committee meeting as well, it's this whole issue between you on a long-term path and journey in your career, in your savings, in your plan, in terms of where you want to end up. And then in between you get these things that happens. Sometimes it's a black swan, sometimes it's just an event. There's a few events happening simultaneously, and yes, you apply filters in your investment process to counter them, the knowns, like climate change or ESG or, this whole social movement. And then something like the corona comes along and it changed the playing field, and it's what you say, it's the short term versus the long term, and do you need to do stuff in the short term? Is things changing? And the concept of risk and mitigating risk, what does risk mean? And how do you mitigate that? That to me, it's a big debate, and it manifests in many things, like the exchange rate is the share price of a country. We know many countries are insolvent right now based on tax collection but it doesn't manifest in what the equity markets does in the short term. But yet we have to plan for that in the long term. And again, it comes back to risk management, risk mitigation. And it has two effects. One for us as advisors and asset managers in terms of the law, which means we have to do due diligence and mitigate risk. What's the definition of risk? And the second part is the narrative, the advice we give clients. And in our equation, the advice is not necessarily to the end client, but to the advisor who speaks to the end client. That narrative, because one of the portfolio managers in the previous meeting correctly articulated it, one must be very careful to focus only on the risk factors as well, because you make people unhappy, literally depressed by doing that. It's talking and speaking the truth versus what you do. And I think that's a very fine line. So it talks to market psychology, because there's a lot. JP Morgan came out, or Morgan Stanley this morning, with a comment around what drives the American markets, etc. And it really boils down to this thing called greed. People are greedy.
I think it's important for us we need to be more paranoid as asset managers now, because it's difficult. It's difficult out there, but you shouldn't transfer that paranoia over to your client. He needs to be aware of the fact that we're disciplined, and probably a bit more disciplined now as portfolio managers. The client doesn't need to see the paranoia.
I think there's always going to be opportunities, and our ability as portfolio managers is obviously to recognize those at kind of an individual level with individual stocks. There's always going to be stocks that are going to outperform the market. And that obviously creates a massive opportunity for us, not only in terms of investing in those stocks, but as you and I always talk about, Bram, in presenting that to a client, and presenting a very interesting story, an expansive story, a story which could really lead the future. So I think that as much as we got to be paranoid about where we put money, a lot of work can go into looking at an individual level what we can actually do for clients.
Boils down to tactical versus strategic asset allocation. So
yeah.
I'm trying to remember who said it. It's one of the books, but he said that basically you have rowing markets and you get sailing markets. So what he was trying to point at is that you have various market conditions that change over time. And sometimes you can sit back, put up your sails, and then the market will just go with the tide kind of thing. So that is, Bram, I think what you're referring to is there are market conditions where you, once in a while, you make an investment decision and you sit back and off you go. What we currently find is more of a rowing market. So there's a constant tactical activity going forward and backwards. And it's a lot more harder work to fathom where you've got to go. And what, in terms of working harder and activity-wise, and I hear what you say in terms of, our own uncertainty, or call it paranoia, whatever you like, shouldn't flow through to clients, and I agree with that. That's what they pay us to do. That's what we do as a profession.